Hey guys, what's up? Alec back with the daily stock market, and look at that, up $140 on the day, and we were even down $160, and it's a Sunday. So you know what that means. Crypto is starting to pop off, so make sure you follow my crypto channel if you're not already, the daily cryptocurrency. Today we are having Sunday stock talk though, so you're going to definitely want to watch this whole video because I'm going to be going over a couple different stock picks, solid ones, banger stocks that you're going to definitely want to see why I'm looking to invest into these and what price points I'm looking in to get in at, and also where I'm looking to sell at. So if you're looking for price points, price alerts, you came to the right channel. Okay, so the first one that we have to talk about today is going to be Disney, ticker symbol DIS. And what's going on with Disney right now? Down 3% in the last week, down 9%, basically 10% in the last month, and 12% in the last 3 months. It's headed towards a 52-week low. And yes, we are talking about the fantastical Disney that everyone loves and adore. And in the last year, well, actually from March 2020 to March 2021, about 1 year, they were up 129%. Disney Plus really helped them out with that. And when they fell off a cliff right here, that was mainly just from, all the COVID stuff and having to shut down Disneyland, Disney World, and all that junk. So we see Disney headed back towards that 52-week low. Is it a good time to pick up Disney? We've seen them peak before in 2019 at $151. So you're basically getting them for the same price in 2019. If you can get in under 150 and even under 130, between 150 and 130 or lower, definitely don't pass it up. Stuff it into a Roth IRA or a long-term account. The good thing about Disney is it also has the metaverse hype that's going to be building around Disney and Disney Plus. And not a lot of people are counting Disney as a metaverse stock right now, but I think that they are going to be catching up on that hype train, and the metaverse is what's hot right now. So this can definitely send Disney stock, especially if they get some good news going behind the metaverse. Then there's definitely huge possibilities that we can see Disney stock at a new all-time high. And if they really nail the metaverse with Disneyland and Disney World, this is definitely one that you will not want to sell and you want to be holding on to for the next 5 to 10 years if you believe in their metaverse plan, along with their Disney Plus subscription-based model business as well. All right, so if we see what analysts have to say about Disney, they actually have a 33% upside on average over the next 12 months. All right, and that's not even baked in with the metaverse. So remember, all these analysts, they're putting these price targets like 5 days ago, 9 days ago, 10 days ago. So there's no real substance behind it for the metaverse. And if they were pricing in the metaverse, they would have probably a lot larger upside, especially over the next 2 to 5 years. So I think Disney can continue to grow, especially if you just stuff them into a long-term account and just forget about them. You can see where some of these analysts are coming from. A lot of 4- and 5-star analysts that are saying in the next 12 months they see Disney stock over $200 per share. We also have a smart score of 8. The analysts have an average moderate buy rating of 205. The online people, blogger opinion is bullish, of course. Hedge fund activity, this is interesting. We see 228,000 share increases over the last quarter. Inside activities, none, and some other stuff you can see there as well. Firstly, as a summary, you see Disney's fiscal 2021 is a product of strong media and entertainment segment that is expected to grow in both paid subscribers and serviced countries. Okay, that's very important. Benefits from an ever-increasing number of vaccinated children and global growth in numbers of adults who have been fully immunized and vaccinated. Disney remains an investable company despite long-term COVID-19 restrictions and careful cash management. And remember, no one's pricing in the metaverse right now for Disney, which is a huge mistake because they can be a dominant player in the metaverse, which we already know how big of a deal that is. Currently trades at a high earning multiple of 143 times, but its future earnings multiple suggest otherwise, which is a very expensive multiple. As one of the most well-known names in the entertainment industry, Disney has a wide range of offerings that appeal to a broad audience of fans, After 2 decades of providing a positive bottom line for investors, Disney was forced to temporarily close its core operation due to the pandemic, tarnishing its long track record of profitability. So remember, that's amazing. How many companies can you look at your stock portfolio and say, hey, this company has proven 2 decades of profitability? So you have to take a look in the mirror or look at your stock portfolio and see what companies are profitable. Are they all growth companies that aren't even turning a profit yet, let alone 2 decades of profitability? Is why Disney is attractive for a long-term hold for me. As of Q4 2021, Disney revenue increased year over year, and the reopening of the economy following the pandemic helped its top line grow, but not enough to exceed consensus estimates, resulting in both missed top line and EPS. However, the pandemic provided Disney another opportunity to focus on the business, which will provide a long-term opportunity on top line of full utilization of the park resorts, which is not yet reflected in today's revenue growth, which is an important point as well. So investment thesis: despite a misconsensus expectation, Disney remains investable due to its strong fundamentals and unchanged credit rating of A2 from Moody's. Revenue growth is expected to be exceptional in the coming year at 24% revenue growth, which is a great growth compared to historical levels and its peers. The company has a sufficient cash flow to resume dividend payments. Disney is currently being consumed by fear, providing potential investors with an opportunity to build a base at a discount. So it's literally giving you an opportunity, if you're a long-term investor, to get into Disney at $150 per share, which you probably won't stick around there for too much longer. Growing subscriber base faster than Netflix, which is important to announce. Disney announced its direct-to-consumer strategy last year, reorganizing its media network, studio entertainment, and direct-to-consumer and international segments into 3 content groups and 1 distribution group in order to accelerate their global media and entertainment growth. Remember, Disney is a global company. It's not just focus on American customers. That's the best part about something like Netflix and investing in Netflix and Disney and other companies that can appeal to a wider audience. They're going after kids that are 6 years old, 4 years old. They're going after adults that are 20, 30, 40 years old, and even 70 or 80 years old. It doesn't matter which language they speak, and they can appeal to all different continents, Asia, Africa, Europe, North America, South America. 1 year after the announcement, Disney increased the total paid subscribers to 179 million from 110 million, which accounts for about a 62% growth year over year increase. The growth is in paid subscribers is remarkable, particularly when compared to one of its peers, Netflix, which saw a single-digit growth of only 8% year over year. Remember, Disney had a 62% year over year growth compared. One reason to bet on Disney's future is the company's momentum in growing its subscriber base. And you can take a second to read that chart below. You can pause it if you want. The park's performance offset by Disney Media. You can read this chart if you want as well. Its Q4 performance still doesn't reflect its full potential, owing to the company's inability to fully utilize its assets over the last 2 years due to the restrictions, which is important to notice. Obviously COVID played a huge detriment in the business. Another value-adding factor is the economy's continued improvement towards recovery, with 41% of the population fully vaccinated and about 10% in children is a good thing to note. Also, it's obviously just going to keep getting better and better and better and more normalized, and not so much of a hindering on Disney's park performance on their business model side. Obviously, Disneyland and Disney World as well. So let me know if you guys like when I dive into stocks a little bit deeper like we just did with Disney. The next stock on the list is going to be Meta. It's actually an ETF, so keep that in mind. It's not really a stock, so it is an ETF, which is great for long-term investing. Typically, when I'm investing in ETFs, one thing I like to look for is past performance and that they have proven success over the last at least 10 years. Now, that's the first thing that obviously doesn't match with this ETF, but we're going to look into it anyway because there's a lot of hype around this ETF. If you don't know about it yet, it's the Metaverse ETF, and it's an easy way to invest into the metaverse. And we'll kind of go over it a little bit more. It just basically hit the markets on June 30th, though. So it is a very new ETF, and its PE ratio is 43. And if you want to see how Meta is weighted, which kind of piqued my interest and actually made me want to invest in this ETF a little bit more, it's kind of interesting how their holdings are dispersed. So you can see the top 10 out of 43 holdings makes up around 56% of its holdings. All right, so the first one is Nvidia at 9%, which is a huge, huge chunk. So if you're Nvidia, if you like Microsoft, if you like Roblox, if you like Facebook, and you believe in those ones, that makes up already about 30% of the entire holdings, just those four stocks. After that, you have Unity Software at 5%. You have Autodesk at 4%. You have CLTD at about 4% as well. Amazon coming in at about 4%. You have Tencent Holdings at about 4%. Immersion Corp, which I'm not too familiar with them, so they're the only real question mark on the list, Immersion Corp, but they're only at 3.7%. So I think the 54% of it is weighted very well. I would like to see some of the other holdings, what the other 50% of this ETF is, but it's probably smaller growth stocks that have huge potential to perform in the metaverse, just like how we are looking for. So this ETF could experience around 20-30% growth per year for the next 5 years or more. It can even see more than that. Especially, I like how it's set up. The top 10 holdings, 50%. I mean, how else would you balance this portfolio if you were running an ETF? I actually have an idea of what I would do. You know, I would probably put Nvidia a little bit lower. I would probably put Facebook a little bit higher. Probably put Unity a little bit higher. I think Roblox is good where it's at. However, it could be a little bit valued at current, overvalued at current prices. However, they have huge, huge potential, Roblox, so they can be undervalued potentially. They are one of the hardest stocks to value, in my opinion, just because we don't know where they're going to be landing with the metaverse. Are they going to be running the metaverse and the leaders of the metaverse, which they can easily, they have potential to be runners up with Facebook or be bigger than Facebook in the metaverse specifically. They already have a huge user base. It's already built out properly. Obviously, Facebook has a huge user base also with around, I think it's 3 billion daily users that log on to Facebook every day. 3 billion. That's almost half the entire world. So keep that in mind. Meta platforms, aka Facebook's a great one to be investing in. I'd probably put that closer to 10%, honestly, of this ETF. And Amazon, I would definitely put higher too, to like around 5 or 6%, maybe even 7% on something like Amazon. I think Autodesk and C are great ones as well, but I definitely have to look a little bit more into something like C. So here you can see it's probably just the beginning of major consumer products looking to make a splash in the metaverse. Investors seem to be ahead of the curve with this new ETF, which is Meta that we're talking about, crossing over 500 million in assets under management in just 2 weeks after reaching 250 million. So the market cap's growing, or assets under management are growing extremely rapidly. I think it's closer to 800 million under management now, and I wouldn't be surprised if this grows to a 5 to 10 billion assets under management anytime soon. So in my opinion, it's still super early to get in at only $16, $17, $18, $20 per share. Obviously, if you can get in closer to $14 or under $15 per share, it's going to be beneficial over the long term. It's probably one that you don't want to buy in all at once, especially because you see the most weighted positions, you know, the 50%, the top 10 positions are extremely not overvalued. I don't want to use that word, but they're very frothy, let's say. You know, they are extreme. They're at all-time highs. They've been huge percentage gains over the last few months. So you might want a dollar cost average into something like Meta. And if we see some of those big stocks taking a hit, or, you know, the metaverse hype cooling off, That's really when you want to start investing into these stocks once the hype dies off, and hopefully we'll see Meta ETF closer to 15 or under $15 per share. And let's finish the list off with Meta platforms or Facebook. Okay, so this one, they're not doing much movement in the last month since they've announced their metaverse platform. Obviously, they were down to like 312, peaked up a little bit, but the overall performance in the month hasn't really changed. So in my opinion, it's still a great place to be buying Meta platforms, especially if you're a long-term investor. I think that they will be a leader whether we like it or not in the metaverse. And they might not even be like the go-to person, but they're definitely going to have some role in some form of metaverse holdings. And obviously, changing the name is making a statement very early that they're going to be a dominant player in the metaverse space. Microsoft is obviously another one, probably going to be their biggest competitor in that metaverse space, but they're going to be different, I think. Facebook is obviously more of a social media platform, peer to person, so you can actually, talk to friends, family members, and things like that. Microsoft is completely different. They're more video game oriented, obviously, and computer oriented. So they can probably be developing like the headsets, the software, the hardware. So Microsoft is probably going to be developing more of the hardware while Facebook does more of the software applications and build out Facebook app and WhatsApp and Oculus as well to be a dominant player. So Facebook could also be huge in the hardware aspect of the metaverse as well, because they do have Oculus they're doing as well. And obviously we don't have to do a big, huge deep dive into Facebook to, well, we shouldn't have to do a big, huge dive into Facebook to understand that Facebook is one of the best stocks that you could be investing in over the next 5 to 10 years. Now, I'm not saying that this is going to be the best stock in the next 1 year, 2 year, but I think that Facebook, if you didn't know, their market value is their market cap is under $1 trillion. All right, Microsoft is $2 trillion, for example. Apple's $2 trillion. Some of these bigger companies that you kind of picture with Facebook are in that $2 trillion range. So Facebook has one of the smaller market caps out of those huge, huge companies that you want to be invested in over the long term. The PE ratio is relatively low, only a 24 PE ratio, which is extremely impressive for Facebook. I obviously have $2,500 just in my short-term account. We've already made $160 off that, and I think that will be an easy swing trade to around $400 per share, although I will be tempted to hold for long-term. I have an additional probably $5,000 to $7,000 to $10,000 in my long-term accounts as well for Facebook that I'm not planning on touching for at least 5 years minimum. So if you like to invest like that, Facebook can be a good one for you. If you have a Roth IRA, 401k, anything that you can't touch for a long time, any kind of IRA, Facebook is going to be a great one for you. And honestly, all the stocks that we talked about are going to be great ones for you on this list, on this video today. Also, Facebook, one last quick note, dollar cost averaging is a great thing to do. So I'm not saying, I wouldn't always recommend to go out and buy $2,500 worth of Facebook today, although I think it's a fair price. I think dollar cost averaging, that's what I personally do. That's how I developed such a large position into Facebook and some of my other larger positions. I put in something like $200 a week, $100 a week, maybe even $500 a week, depending on how aggressive I want to be with that position. So guys, smash a thumbs up if you appreciate this detailed content, me cracking open my mind and helping you guys out trying to make some money in the stock market, especially any beginners out there. Go ahead and DM me on Instagram. I have a few more spots I need to fill on my close friends list, and I have a beginner friendly program, step-by-step video walkthrough on all my tips and tricks that I've learned over 5 years of the stock market, so you don't have to make those easy beginner mistakes. And if you want one-on-one coaching, I also have that. I can take you under my wing and show you how to become a better stock market investor step by step as well. So guys, share it with a friend. I'll see you in the next video. Remember, don't time the market, buy the market. Peace.